Hey everyone, and welcome to Tax Tuesday with the Tax Queen. I am Heather Ryan, and I'm here to answer questions for digital nomads, RVers, and other travelers as they go about their life and have tax questions. So I did get quite a few questions ahead of time. If you've never done this before, I do always answer submitted questions prior to jumping into anything that might be handled live. So I get through them all. And if you have some follow-up, if that is your question and there's some follow-up, feel free to type it in the chat. Otherwise, also, I want to make sure everyone can hear me. So if you're live joining me, just let me know all is good. Sometimes I have a tech issue, it happens. So otherwise, I'm going to jump ahead and go into the questions that I had live. And let's see. First question. How does travel for business work? If a tax home is in a certain state and I'm there during the summer, but during the winter I need to fly for a job, can you write off the whole travel expense? So travel for business is really about duplicating expenses. And what I mean by that is if you're leaving your home behind, right? So you're leaving an RV, you're leaving an apartment or a home, you're leaving your family, maybe a spouse, children, right? You're leaving them behind. You're flying or driving, taking a train. I don't care the mode of transportation, but you're duplicating those expenses. So by staying in a hotel or an Airbnb, by having food and things outside of the home, a rental car, all that stuff, right? So I'm duplicating my living expenses. Therefore, that travel would then be for business. If you're not duplicating your expenses, then it would not count. And I say this because people that are RVers that full-time or even digital nomads, all of your travel expenses don't count for business, right? Because that's a personal lifestyle choice. But if you left your RV behind, like let's say it's parked in Florida for the winter, and you left your RV behind and you flew to Las Vegas for a conference, that would make sense, right? That would be business travel. So I hope that clarifies that up. And I'm just going to share a link. I have a nice little blog article about that. That might help. But yeah, really, business travel has to be duplicating expenses. There's also very strict rules of how much time has to be spent on business activities. So if you're talking about, going to a gathering or something for networking, right? If you travel there the week before and then you only have 1 or 2 days of networking, that week before doesn't count, right? That's personal. So just be careful about that. There's a lot of guidelines around travel and taking it as a business expense. Second question, if I use my personal debit card to make business purchases, what should I do to make it easier when filing business taxes? Simple answer is don't use your personal credit card for business transactions. That's the biggest thing I can stress. No matter how small your business is, it's a side hustle, whatever else, have separate bank accounts and credit cards specifically for business income and business expenses. So that's a big no-no. As far as making sure you have all the expenses tracked, use bookkeeping software, use a spreadsheet if that's something you're going to keep up with and can handle, you actually are going to keep up with it and not miss expenses. That's why I like bookkeeping software because it doesn't let us miss things, right? It's automating, it's pulling those numbers in, so we don't miss numbers. So that's really the biggest. There's kind of two questions in there, but yeah, don't commingle money. Always keep things separate. Again, no matter how small or how big, keep it separate. Okay. Next question. Um, we are both single member LLCs and work as contractors. How do we fill out a W-9? So W-9 has remained the same for as many years as I can remember. If you are a single member LLC, which I feel like I answer this every single Tax Tuesday, single member LLCs are sole proprietors. A single member LLC means nothing for tax purposes. For the IRS, they don't care. It's a state legal entity. So again, single member LLC is a state legal entity. It is a Schedule C sole proprietor for tax purposes. So it's nothing, right? You're just doing business as yourself. That's how the IRS sees it. The term that they use, if you're looking for that on Google or whatever, is a disregarded entity. So a single member LLC is a disregarded entity. Again, it's a state level legal entity. So they are looking for the tax stuff, which is just you. It doesn't matter if you have an EIN, which is your employee identification number, it still goes to your Social Security. It's tied to you. So I hope that clarifies that. Um, and just also like on that W-9, there is a section for an LLC. An LLC there would be if you're treated as a corporation or a partnership. So you usually, if you're an S corp, that's fine. Or if you elect to be treated as a C corp, or if you have multiple members to your LLC, you most likely are a partnership by default. That helps. My business is a sole proprietor and I need to remain a sole proprietor, not an LLC for very specific purposes. Can I elect S corp? So let's go back and step back here, right? S corp is a tax election, so you got that part. Clearly understand that part. But a tax election has to have an entity, and a sole proprietor is not an entity. And a sole proprietor is just you. So going back to our, previous kind of that whole LLC, right? LLC is an entity, and that's why it can elect to be an S corp. Same thing with if you have an Inc. like next to your name, so like Tax Queen Inc., right? That's an entity. So that can elect S corp taxation. So the S corp taxation has to have an entity in order to elect it. So if you cannot become an entity and you have to remain a sole proprietor, then I'm sorry, the S corp is not going to be available to you. And this is why a lot of times I recommend forming that LLC kind of pretty quickly when you form a business, because you want to be ready to take that next step if the S corp fits you at a later date. Most businesses, as they start off, it does not make sense. It does not fit. It's not appropriate. It's just too much extra work, and there's no tax savings. But once you get big enough, and we just never know when that might happen, what year that would happen. So if we start off with that legal entity from the beginning, then when we're ready, we can make that S corp election and it's available to us. Maybe that's a little more detailed than that question asked, but I like to give details. My understanding for charitable contributions this year is your AGI times 5% is how much. So, all right. Charitable contributions, that's kind of what this question is getting at. Charitable contributions for 2025 this is not applicable. So 2025, it's 60% cash and 50% non-cash, right? That's what we can take. Remember, charitable contributions for 2025 are part of our itemized deductions. So if our standard deduction is higher, we don't even need to factor the charitable contributions. If we have a lot of charitable contributions, maybe we have some medical expenses, maybe we have mortgage interest or loan interest of some sort that we can qualify for our home. We have real estate taxes. I'm talking Nomads, so I'm guessing a lot of you don't have this. But that's what compromises our itemized. So medical expenses above and beyond, right? Kind of 7.5% of our AGI. Real estate taxes, mortgage interest, charitable contributions, all of these things. State taxes, if you have them. So most of the people are not seeing, that in general. And it's very high with that standard deduction. If you're married filing jointly, it's over 30,000. It's 15 if you're single, and it goes even higher if you're over 65. So you get added bonus. So I'm rarely seeing itemized deductions. So this question is getting at it because the One Big Beautiful Bill Act that was passed in July of this year, of 2025, did change charitable contributions. So starting 2026, everybody, non-itemizers, right? So those who are not itemizing, taking that standard deduction, get $1,000 if you're single and $2,000 if you're married filing joint. So if you make $1,000 worth of contributions, you can take that whether you itemize or not. We call this above the line. So just be aware of that for 2026. So for 2025, that will not apply, but for 2026, it will. Hope that helps answer that question. It did change with the recent act this summer. So yeah, there's a lot of changes in there. I will be buying an LLC to be part owner in a new business. I'd like to have take my money out of an RA to do this. Are there things I should be aware of and any tax protection? So there's a couple of things um, here. There is a tax provision, and I don't talk about it much, and it's called ROBS. It's called rollover, or that stands for ROBS stands for rollovers as a business startup. So it allows you to withdraw from an IRA and put that money to buy stock or whatever in a company. And that makes that tax-free, that withdrawal tax-free. There's a lot of nuances there, and I'm not going to get into that here specifically. So it's called ROBS, and I will share an actual IRS website. So that might be able to help you if you're uh, into that. Otherwise, you can withdraw the money from the IRA as you normally would, and you're going to be taxed on it if you don't do the ROBS. So that rollover as a business startup. Again, the ROBS, the rollover as a business startup, has a lot of nuances. So be really careful there if you do look into that. Um, it's it's not that it's a super challenge, but there's a lot of rules to abide by. So. Otherwise, yeah, you're just going to pull. So like if you pulled, I don't know, 50 grand, right, that you're going to contribute into and buy into that business, then that 50 grand would be taxed just like normal on a IRA withdrawal. Let's see, required minimum distribution requirements. What are they? So required minimum distribution is pulling from retirement account. So an IRA, 401k, you were required by law at the age of 73 to pull. So starting the April 1st of the year following that you turn 73, you are required to pull. There's certain calculations that are required to meet that minimum distribution. It's not usually a huge burden for most people. It's just a requirement. And sometimes I say you have to withdraw the money from the 401k or the IRA, but you don't have to actually put the money in your own checking account. It could just be withdrawn and go into some other kind of investment if you don't need it to live, right? If you're just taking it out because of that required minimum, um, it's possible. So don't be too scared of the RMDs. Work with a financial advisor. I do recommend that. I am not a financial advisor. I'm just a tax advisor. If you have questions about the RMDs. So that is also a change, that 73 age, if you're in that category. All right, those of you who are here live, that is all the questions I got as previous submissions. So if you're interested and have any submissions, live questions, I will stay on a couple of minutes just here to see. The next Tax Tuesday, just in case you're interested, I'm going to skip January. I'm actually going to be traveling outside the country, and it's just going to be hard for me. So I'm going to skip that and take a break. And I will be back in February. So February 3rd of 2026. I can't believe we're almost at 2026. But that will be the next Tax Tuesday. And let me just grab, if you have questions, you're also welcome to submit them ahead of time. And as always, there's that link for the Tax Tuesday questions. If you have them, anytime between now and late January, early February, before that February 3rd date, feel free to submit them, because if you submit them tomorrow, they just get added on for the next time. So unless I have any other live questions, I will be signing off. Anyone here? Should I say going? But yeah, so I hope you enjoyed it. I hope you have a great holiday season and a great end of the year, great December, and I will see you in February.